Hello traders, if you've ever struggled with identifying market cycles or found long-term trends distracting, then you need to check out the Detrended Price Oscillator, or the DPO for short. Now, unlike other indicators that track trends, the DPO is designed to remove long-term movements. Right? It's designed to remove long-term movements, allowing traders to focus purely on short-term price cycles. So in this video, we're going to cover everything you need to know about the Detrended Price Oscillator, including how it works, how to use it effectively, and how to combine it with other tools to enhance your trading strategy. Okay, now let's just get started real quick. So what exactly is the Detrended Price Oscillator? What does the DPO do? What is the benefit of this indicator? Now, the Detrended Price Oscillator is a momentum-based indicator that removes long-term trends from price action. Yeah, so this helps traders focus on short-term cycles, making it easier to identify overbought and oversold levels without the interference of broader market trends. So here's how it works. Yeah, the DPO calculates the difference between past prices and the moving average over a set period. So instead of following trends, the DPO focuses on price cycles, making it ideal for identifying market highs and lows before reversals. So the DPO moves above and below the zero line. You can see the zero line around here, right? So it moves above and below the zero line, helping traders spot momentum shifts in the market. So unlike oscillators such as the RSI or MACD, the DPO is not used for trend following, but rather for isolating short-term price movements. Okay, so now you might be wondering, how do you use the Detrended Price Oscillator in your trading, right? Let's go into that real quick. The DPO is particularly useful in range-bound markets. Okay, it's particularly useful in range-bound markets. All right, where price cycles are more predictable. So here's how traders can use it effectively. In identifying overbought and oversold conditions. So basically, when the DPO reaches extreme positive values, like what we can see happened around here, right? It suggests that price is overbought and a potential downturn might follow. Like we can see what happened here, right? As it got to the extreme top again, it showed that, downtrend was likely to follow. And you can see that a downtrend actually followed, And then here again, you can see what happened when we had this. You can see this, and you can see that a downtrend actually followed. And then you can see, okay, well, this was to an extent though, but you can see that there was actually a following downtrend, and you can see what happened here, right? So basically, you can take advantage of this indicator using it in a ranging market, and then watching out for the extremity of its values. When the DPO rises to the extreme top, you'll be looking out for sell opportunities. And when it falls to the extreme bottom, when it dips to the extreme negative values, it signals oversold conditions. Like you can see what we had happen here, right? Extreme, negative value signaling oversold conditions. So meaning the price could bounce back up, and you can see that that's what happened, right? So these levels may vary, depending on the asset and time frame being traded, right? Now you can also use this indicator to spot market cycles, right? The DPO helps traders identify repeating price cycles, making it easier to time entries and exits. So short-term traders can actually use lower DPO settings to capture quick swings, while long-term traders may prefer a higher period setting. Right? If you go to the inputs, the length, you can decide. Short-term traders can actually reduce the value here, while longer-term traders might prefer higher values to smooth out minor fluctuations. Okay? And you can also combine the DPO with other indicators, obviously. The DPO works best when combined with other technical indicators for confirmation. All right. So you can actually decide to pair it with the moving averages, in order to determine whether a short-term cycle aligns with the broader trend. All right. Also, you can use the DPO with RSI or stochastic oscillator, just to get an idea, right, about overbought and oversold signals with respect to momentum. Okay. So now, the ideal DPO settings actually depend on the type of market and trading strategy. If you're a scalper or day trader, you can consider changing this to 14. Right, you can consider changing this to 14 if you are a scalper or a day trader, right? Because it's going to provide you with faster signals for quick trades. But if you are a swing trader, then you can use the 20 setting. All right, the 20 period setting can help you capture medium-term price cycles. If you are a position trader, a 50 setting, you can use the 50. The 50 period DPO filters out short-term noise and focuses on larger cycles. So whatever setting you are using, you can just fill it in there and click on OK, right? So now you can actually decide to experiment with different DPO periods, okay? That's going to allow you to adjust the indicator to match your trading style and market conditions, okay? So now, supposing the DPO has been rising, supposing it has been rising and then reaches an extreme overbought level. At the same time, a key resistance level. You can see like what we had happen around here, right? A key resistance zone. Price happens to get towards that zone as the DPO rise to an extreme, rose to an extreme level, overbought level. So this suggests that price might reverse downward, creating a sell opportunity. So if you had entered a sell around here, it would have actually been a good one, right? It would have been a good one. Set your stop loss above the previous swing high, and then your take profit can actually be at key support zones. The next key support zone. Conversely, if the DPO is in extreme oversold level and price is nearing a support, you can see like what we had here. Price perhaps was nearing a support zone, and then you have the DPO around extreme. This was not even exactly extreme per se. Okay, so I'm just going to use this as an example. Okay, because even though that price eventually went up, but the DPO was not an extreme, right? This was an extreme to an extent, right? You can see the value. Okay, so this was an example. Price got towards the extreme oversold, and at the same time, the DPO got to the extreme oversold, and at the same time, price was retesting a key support level. So this would have been a great place to enter a buy after you get your confirmation, of course. Obviously, after you get your confirmation, then you can set your stop loss below the previous swing low, and you can target resistance zones for your take profit. Okay, so the Detrended Price Oscillator is a powerful tool for traders who want to focus on short-term market cycles without being influenced by long-term trends. Okay, by analyzing these short-term price cycles, traders can anticipate reversals before they happen and improve their timing for trade entries and exits. It works best when used in range-bound markets and combined with other technical indicators for confirmation. So if you found this breakdown helpful, hit that like button and subscribe for more trading insights. Okay, turn on notifications so you never miss a new strategy breakdown. Have you used the DPO in your trading before? Drop a comment below and let us discuss how it has worked for you. See you in the next video, and happy trading.